All right, welcome everyone. Welcome to today's webinar on too little or too much money in railroad retirement and the extraordinary upside potential on the sequence of return risk of railroad retirement. A lot to chew on that there. So basically what I want to talk about is, to summarize, is you have this nest egg in railroad retirement, right? You retired from the railroad, and how do you want to spend down that money? What withdrawal strategies do you have on that nest egg in railroad retirement? And the extraordinary upside potential that I talk about is that statistically, and I'll show you through later in the webinar, is the potential to actually have quite a bit of money depending upon your withdrawal rate as we go through it. So this webinar should take about 45 minutes. We'll take some questions at the end. And let's jump into it. So my name is John McNamara with Highball Advisors. I'm a registered investment advisor in South Carolina, and here's my disclaimer. So this is for educational purposes only. It's not there's no recommendation of purchase of sales of any securities. So and you can all read the rest at your convenience. So let's jump in. So when I work with railroad retirees, and basically, I mean, these questions are fundamental to even non-railroaders. It's all about, I have this nest egg. Is it enough, right? I don't want to run out, or, I want to do X in retirement, and I want to spend this amount of money. Will this be safe? Will it not run out, right? And especially in these recent times, we recorded this in March of 2020, towards the end of March. And, we've had a lot of wild movements in the market lately with the coronavirus going on. So there's a lot of uncertainty. So there's a lot of angst, especially with retirees. Will this money last, right? And that's what we're going to try to talk about today and give you just some ideas on how you want to think about it. So one of the ways that I like to, when I talk about subjects, is, go through examples instead of, and I think, I know myself, I learn a lot better through examples. So let's follow along here. So you have a 60-year-old railroad retiree with, and planning for a 30-year retirement, right? So perhaps at 60 and 30 individual, right? 60 years old and 30 years of service, right? But now they're 60, you plan, say, to 90. It's kind of standard in financial planning practices for another 30 years. And then let's assume a 3% inflation rate and a diversified portfolio of 60% stocks and 40% bonds. We'll rebalance those annually, right? Because they'll get out of balance depending upon market movement. Sometimes at the end of the year, you might have your percentage in stocks might go up and your bonds will go down, or vice versa. And then let's assume stocks earn 10% in this scenario, but obviously a real rate of return of 7, right? Because we factor in inflation. And we have bonds, and they all earn 5 with a real of 2. Average portfolio, it will be an 8% return, okay? And in this example, it will be $1 million retirement portfolio, okay? So, so if you just look at the linear projections of this, right? What does that mean? Is look at the red line. Red line is on the right side axis here, is $1 million, right? If you're going to draw down your spending, that $1 million at the end of the 30 years should be, if in a perfect world, should be at 0, right? You've had the $1 million, you're able to spend the whole thing down and increase the spending because of inflation, right? That initial withdrawal rate, but you have to increase it every year at inflation, and then it should be perfect at the end. At the end of the 30 years, in this case, 90 years old, you're out of money, but you spent everything perfectly. So that's the perfect world scenario, right? That's the vacuum world. So just looking at a spreadsheet on it, right? So you had $1 million, right? You're going to grow that 8%, so that's $80,000 growth. You're going to have your withdrawal every year, and you have your balances, right? But you keep spending down because you're compounding on inflation. And then you get to that final year, you have $143,000 left. You spend it down, small amount of growth on it, final portfolio withdrawal, and then at the end, you wind up in 0. That's $0, right? So that's that linear projection, right? So here's what you want to learn, right? How much can you safely be spent? In that scenario, right, it's almost $66,000, or 6.6% of would be your initial withdrawal rate, right? The safe amount that you could take, because you're getting your 8% return, even though you have 5% inflation, but you can do 6.6% is the number that you can take, and you'll be fine, right? But see, at the bottom there, I think is the important, right, is that assumes the returns are the same every year, right? And as we can tell what we're going through currently, returns aren't going to be the same every year, right? We're going to have, we had a great bull runs for 11 years. It came to an end in this month, right? And market dropped significantly, and it's moving back a little bit higher here as of, March 30th, 31st. So let's just kind of show you what I talk about when I talk about the sequence of risk in kind of real world, in the real world. So these charts are put out by JP Morgan. I want to give credit to them. So just look, this goes back to 1980, and this is performance of the S&P 500 since 1980. And as you can see, the gray bars with the gray numbers, they represent the year-end return, and the red numbers are the lows for the year. So even though we have, as you can see, a lot more positive years, you still had a lot of, you almost had a negative down part of the year in every year, even though they were down. So, starting in 1980, you were down 17% at one time in 1980, but finished the year up 26%. That's a massive move. You go all the way through at it. To today, where you say, okay, well, it was down 34% was the low so far this year, and right now we're down about 21%. So it has rallied back pretty significantly, right? 13%, that's a pretty big rally back. And then, you can see the financial crisis here, down 49%, came back up 38%. Even look at 2009, which is unbelievable, down 28%, and then finished up the year up 23%. Some very, very big moves. I thought this was kind of interesting, actually, was down. It's down 34% this year, and you go back to 1987. It's kind of when I started. It was down 34% in October. This was October crash of 1987, and finished the year up 2%. So that's quite a move in the market in 2.5 months basically to rally up that much. So that's kind of historically take a look at one more historical chart. Just I like to put market moves into perspective. I know with the latest cable news cycle or financial news cycle, we're minute by minute, tick by tick, and it's really not a good way to look at markets by any stretch of the imagination. I can't even explain to you how not to look at markets like that. So even if in this chart, it goes back to 1900s, and basically from the bottom of the Great Depression, the market has been, it's been on a tear since 1930. I mean, how do you even talk about that? But look at the events that have gone on, and I would even say bigger than this coronavirus, to be perfectly honest with you. I would think World War II, frankly, where the whole world is killing each other, is probably a bigger event than coronavirus. We got through that. Korean War, I mean, the whole Cold War, frankly, I mean, you're on the verge of nuclear exchange. That's pretty serious, I would think. Vietnam War, you had oil shocks, the inflation. I mean, who remembers the 70s with inflation going through the roof, 10, 11%, 12% inflation. Interest rates, 20%, got through that. Had a great boom during the Reagan and Clinton up to, the internet boom of 2000. We had a couple Gulf Wars. So then you had the financial crisis here at the end, which, frankly, I think was probably one of the scariest ones since the Great Depression, when the financial institutions, really the backbone of our whole economy, was really on the ropes. And look at the way you bounce back from that one to where we are today. So we'll see how this virus plays out. I'm not a doctor, and I don't pretend to play one on TV. But, you know, when I just look at the long-term chart, I feel, you know, we're probably still in good straits here. So when we talk about, you know, it's all about the sequence of return risk is what we're talking about. So we'll continue to use some more examples to illustrate what I'm talking about. So in this scenario, let's just say average return for stocks is 10%, but we'll vary the years of return. So what if the first 2 years of somebody's retirement, right? So they retired, but the first 2 years of retirement, their nest egg is going to earn 0% and 0%. But on the last 2 years, they're going to earn 20% and 20%. All right. And then in the next scenario, their first 2 years, they'll earn 20% and 20%. And then the last 2 years, they'll earn 0% and 0%. So this is on a portfolio of, like $1 million portfolio here, right? So $1 million portfolio, right, represents the portfolio value in the red line, right, the end of year balance. But your first 2 years are 0, and you're spending down, right? You're spending at that 6.6% that we talked about in the previous one, right? And your inflation's at 3%, so you got to keep spending, right? Because inflation, you know, you gotta survive, so you got to keep spending. But your first 2 years are 0, right? And as you can see, those 2 years, the impact that it has, as you keep spending, even though you're earning very well in those subsequent years, you run out of cash around 84, and you don't get, excuse me, you don't get the advantage of those last 2 years of 20%, because 20% of 0 is 0. I mean, it could be 80% in those last 2 years. Oh, the market was up 80%. Oh, great, I have no money. So that's illustrating sequence of return risk, right? How important those first years of your retirement can really sometimes set up your whole retirement, right? So, return average, it doesn't really matter what your return average. Remember, oh, stocks over the last 50 years have earned 8%. Well, that really doesn't matter if that's the average return if your first 2 years are negative or whatever. So you got to plan for these things, and that's what we'll talk about. Let's look at this next example where we'll flip it, right? So let's go 20% the first 2 years, right? So imagine this, $1 million, I get first 2 years at 20%, and my last 2 years are at 0. So I've covered all my spending, right? The $1 million, right? And then at the end of the plan, at the end, I still have my $1 million back. So how great is that, right? So I still took my 6.6% spending, but the early years compounding effect, right? Those first 2 years, I was able to keep my $1 million throughout the whole time and return that money. So how great is that? That's a good one. So now let's kind of look at a real life scenario here. I chose these 30 years here from 1969 to 1999. Now, this is a very interesting time. So inflation, it's high, 5.33%, that's high. But look at the equity returns, right? That's almost 13.5%. Obviously, you subtract the inflation, 8.8% real. And then your bonds, they were high back then, right? Interest rates were high, 8.62%. Okay, so what is the linear safe withdrawal rate, right? That's that vacuum I talk about, where we want to end with $0 at the end, right? And cover all our spending throughout the years, right? Because our spending, remember, every year, because we have inflation, is going to increase 5.33%. So we have to earn, right, that money to cover our inflation. But with this scenario, from 1969 to 1999, the average portfolio returned 11.48%. How fantastic is that? You can never go broke with that, right? If I told you that you could do 11.48%, you would probably say, hey, thank you very much, Mr. Madoff. You're fantastic. But that's what happened, 1969 to 1999. The average portfolio return was 11.48%, right? So there's no way you can go broke, right? Well, wrong. So here's the linear projections, right? So this is that perfect vacuum with 11.48% and that 5.3% return. That's great. You wind up at 0. And then, right, how much can you spend safely with that 11.48% return? The answer is $74,000 a year. Or imagine that, 7.4% withdrawal rate, because you're getting 11.48%. So, you know, so if you look back, right, that's $74,000 right here. And, you know, you're putting that inflation 5.3%. I mean, look, you go from $74,000 in your first year, and because that inflation is such a killer, that last year, actually the last 3 years, you're spending $1 million, right? Because that last year is 350. So you're going like 300, 325, 350. So yeah, it's like $1 million right there. But hey, that's okay. You're getting an 11.5% return, so you should be able to make it, right? That should be no problem. But here's the real world. Here's what really happened. All right. So your early years were horrible. So even though you had that 11.48%, you got, you know, the market started tanking, and then the bear market came of 73, 74 bear market, right? Market kept going down, and then by 73, you're flat broke, right? You had all these bad returns coming through, right? And not to say they were bad returns, but you have to remember that your inflation is kicking in every year. So, you know, at that 7.4% withdrawal rate, and then you add the inflation every year, right? That's going to keep going up, that inflation. But now you're not getting that sequence of returns. And then by 1972, 73, right, bear markets come and you're out of money. So in this case, you're out of money in 1973, you're out of money. So you're flat broke in 12 years, basically, from when you retired. So that's not really that good of a scenario, because look what happened, right? So you say to yourself, well, John, you said it's 11.48% equity returns. Yeah, and you know where those came from? That came from the 1980s, right? The bull market of the Reagan administration in the 1980s, right? Cleaned up inflation and the market took off, and you can't participate in it because of the sequence of return risks, right? Your withdrawal rates, they weren't correct, right? So we have to figure that out. So this is kind of interesting here. Let me show you this. If you take the reverse it, right, kind of a Benjamin Button type thing, go back in time, 1999 to 1969, right? And you reverse it, say, okay, well, I'm going to take the 1999 and work my way back. Well, I know those years are good. You take that initial $1 million, and it actually tops out towards the end of the cycle up over $10 million. That bear market comes, that what I was talking about, the 73, 74 market, boo-hoo, your 10 million goes to 8 million, all right, and then you still finish out with about $8.5 million, even though you know, you had some inflation spikes and all that, stocks tanked, but that doesn't matter, because your early years, your portfolio was just going through the roof. So that's on that reverse. So that's what I'm talking about, that sequence of returns, you know, getting those good years in to build that portfolio so you can weather some of the bad returns that, you know, that will eventually come, right? So it's not a matter of, oh, geez, I hope the bad returns don't come. It's like, well, when the bad returns come, because they will come. I mean, that's why, you know, in 11.48% return, well, you're going to have obviously some good years and bad years, but you have to be in the game, so to speak, to stay in the market so you can capture those good returns. That's what we want to talk about, is trying to capture those good returns. You want to be there. So here's kind of the takeaway, right? is how important those, when I was talking about those years, right, those sequences, how they affect you, right? And it's not just about the crashes, right? Because as we've seen, and I talked to you about like in 1987, you know, down 34%, but look how quick that recovery was. It would, you know, finish the year up 2%, okay? 2009, it was down, I think, what did I say? It was down 23% and finished up another 23%. So it's those quick recoveries, right? You don't want those extended bear markets. Those are killers. You know, hey, it's down 6% 1 year, down 7%, down 8%, down 2%, right? Those are very bad. But, it, you know, you can weather that. Oh, I'm down 20%, but next year I'm up 4%. Then the following year I'm up 8%, 10%. You can do it that way. But it's the extended periods of low returns that can really have a detriment on your secret of your retirement nest egg. So how do we manage this, right? How do you, you know, I got this retirement nest egg, now I'm scared. I got all these markets going, you know, markets going all over the place. I don't want to withdraw. So you have to establish, what is that safe withdrawal rate? What's the amount that I can take out every year? You know, be protected against inflation, but not, I still want to have my portfolio. I don't want it to go negative because I need the money, right? So what's that rate have? So we'll talk about safe withdrawal rates. Okay, and then we also have dynamic asset allocation strategies, right? How I position my portfolio, what's the right type of investments that we want to look at, you know, equities, fixed income, you know, value, all, you know, all those terms on how to position, you know, your nest eggs. And then spending, right? I have this nest egg, how do I draw it down? What's the proper way to do it? Do I just set, you know, a certain rate and just stick to it, or a rate plus inflation and that's it, and, you know, with the blinders on for, and go that way? Or do I, you know, or there are other ways? And I'll talk about some dynamic spending strategies, but let's first talk about, you know, what is a safe withdrawal rate? So this is interesting here. So this goes back to 1871. This was put by Michael Kitces. If you get a chance, go to kitces.com. Tremendous resource if you're really into the minutia of financial planning, investment management. You know, it's a little technical, a lot of this stuff, but if you can get through it, you can learn a lot, that's for sure. So he went back and looked at 30-year sequences, right? So retired in X year, and then how did that portfolio for the next 30 years perform? And it was a 60% equity portfolio, 40% fixed income, right? So how much could they withdraw from that portfolio safely, right, to achieve their goals, right? So it looks like here in 1966 was the worst drawdown, right? The safe, which the lowest that they could withdraw in 1966 was 4% of the portfolio, right? That was the safe withdrawal rate. So for 30 years, right, if you retired in 1966, you could have taken 4% of your portfolio, and you would not run money, would have run out of money on a 4% safe withdrawal rate. Okay, but if you look at the average, right, from 1871 through, it looks like 1986, 87, the average is a 6.5% long-term average, right? That's the average. So, so that's where you got the, when you look at a chart like this, that's how you'll see a lot of people talk about the 4% rule. Well, the reason they came up with the 4% rule is they looked at it and go, well, what's the worst one? Well, it's 1966, or so 4%, that will be the worst one. And they say they took a look at it and they go, well, I got 110 years of data. And we have a lot of crazy events in there, from the Great Depression to some early years, obviously, in the late 1800s, the bank runs and all panics and all that. Got a couple world wars in there, you know, you have inflation spikes, a lot of things going on in there. So they say 4%, feel that's a great number. So that's how they come up. That's how they came, basically how they came up with the 4% rule. So let's continue with our safe withdrawal rate. This is on $100,000, right? $100,000, 60/40. So there's your, once again, that's your 4% that we talked about there. And there's your low there in 1966, right? But every other year you're fine. I mean, even look in, if you retired in, what was that, 1973, okay? At the end of your 30 years, you would have 9 times your money on the initial 900,000. So you would have 100,000, you'd be at $900,000, right? So how great is that? Those are great years to retire. And why is that? It's like you retired, like you retired the year after a market collapse. So you're basically buying equities at a very cheap discount. That's where it seems. So if you retired in 73, 74, and you put your money away, well, you caught that whole bull market of the 80s, and that's why you're seeing some at this end here these great sequences of returns here, because you had a very, very strong market. But let's look at the 5% over here. Geez, 5% doesn't cut it, because there's quite a few years here that that the portfolio depleted, right? So your $100,000 went away and got into negative. So that kind of really doesn't work there. But, you know, it's funny because I said in the previous chart, 6.5% average. Well, that's the average, right? So there's some scenarios that just aren't going to work. So let's look at the 4% one more time here, just to really understand it a little bit more. $1 million starting portfolio. And as you see, the lines here, as they go across, there's at no time they go down to 0. So your bottom 10% of the outcomes, none of them go to 0. And look at the top 10%. They go on a $1 million portfolio. The top 10% basically finished from 6 million up, all the way up to over $9 million on the top 10%. So you're thinking that you're equally as likely to 6 times your retirement portfolio as you are to finish negative. I mean, well, I shouldn't even say negative from the original 1 million. You'll never go below 0 with the 4% withdrawal rate. So that's something you think about. And that's what I'm talking about, that extraordinary upside potential. Because now if I say to myself, wait a second, I'm just as likely to have 3 times as, or in some case, 5 times as much money, right? If you look at these best and worst here, right? Equally likely outcomes. All of these are, oh boy, you know, 3, 4, 5, 6 times more favorable than unfavorable. So that's what I'm talking about, that extraordinary upside. So you have the potential actually to have more risk on the, I shouldn't say risk, but more upside potential, right? So that has to get you thinking though about retirement strategies, right? So if you're just saying I'm 4%, you might be leaving a lot of retirement money, so to speak, on the table. And it depends upon what you want to do in retirement. You know, if you want to do leave a nice nest egg or an estate to your heirs, that's fine. But, you know, some people say, well, you know, I like to spend a little bit more in retirement. You can also do that too, because you might be having some very good years, and you might want to spend down that retirement. Because the reality is, as you get later in retirement, I mean, you don't like to talk about it, but you're just going to slow down as you get towards the into your 80s. You're gonna slow down a little bit. And you probably won't be spending as much, so that's something to keep in mind when you want to talk about retirement spending. So let's go on to the next topic. We went over safe withdrawal rate. Now, dynamic asset allocation. So there's so this is another way to manage that sequence of risk, right, is through dynamic asset allocation. And there's multiple strategies here. I am a big, as a railroader, as someone who works with railroaders, right? I'm not a railroader. I'm a financial planner to railroaders. When you want to talk about, I personally like the annuitization floor, and I'll go on my next slide why that is. But I'll just touch on these. You know, you have the bucket strategy, which is popular. And basically there's, you know, you take your retirement nest egg, you divide it into 3 buckets. First bucket is cash. So your first 3 years will be in cash. Okay, so you say, oh, I'm good for 3 years. I can ride a little down market, right? Because 3 years, so you really won't get many years worse than that. Then your next 7-year bucket would be fixed income. So not too much risk in that. I'm getting a return in that bucket, so that's okay. And then the final bucket would be the next 20 years, and that would be in equities, right? Say, okay, well, I'm going to have ups and downs in equities, but that bucket I don't need for a while because I've got my 3-year cash bucket, I got my 7-year fixed income bucket, and then my equity bucket. So those are the bucket strategies, and you kind of move one to the other every year to fill up the bucket. So that's the bucket strategy. Then you have the rising equity glide path, and that's really for people who you increase your equity exposure later in retirement. And it's for a lot of people who annuitize their retirement income because the value of the annuity decreases as they get older. So actually they're exposed to more equities. And then you have the valuation-based asset approach. And simply that says, okay, we're going to adjust our portfolio. You know, we were talking about the 60-40 portfolio. But you're going to get a little more, you're going to change that more. You're going to be a little bit more dynamic where you're going to say, well, stocks are very expensive here, you know, based off like a PE ratio, price to earnings ratio. So I'm going to buy a little more bonds and have a little less stocks, or vice versa. Stocks are really cheap down here. I'm going to load up on stocks and cut down my exposure on fixed income. So that's kind of that valuation-based asset approach. You know, a lot of people will use that. You know, you ever hear the term value investors? It's kind of the same thing. They buy assets when they're very much discounted and they don't feel they're getting properly valued for how much they feel they're worth. So that's kind of that approach, very dynamic type approach for sure. So what I like to talk about is the annuitization floor for railroaders. Is kind of the way I look at it. And it's really the way you have the two buckets, right? And if you look on the left, you have the discretionary bucket, right? So this is, I'm going to cover all my expenses with the, the essential bucket. I'm going to cover all my expenses with the essential bucket. So, you know, that's housing, food, clothing, cable, Netflix, out to the restaurant once a week, whatever those essential things that you have to do in retirement, right? I'm going to cover all those with my Tier 1 and Tier 2 retirement annuities from the Railroad Retirement Board, right? Because they pay out fantastic. So that can cover, you know, the approach I like to have when I work with clients is like, if I can get my essential expenses, 80% of them covered with guaranteed retirement income streams, Tier 1, Tier 2. Some of you might have pensions. That's fantastic. Then you're setting yourself up for a fantastic retirement, that's for sure. And then the portfolio, right, the 401k or IRAs or any other retirement assets that you have, Roths, that type of thing, that would go into discretionary, okay? That would be discretionary spending, and that would determine how, you know, when I talk about discretionary, be, okay, I want to, you know, I'm going to do the trip to Europe, the cruise, the RV, whatever it is, and, you know, 4 times a week to restaurants, that type of thing. I'm going to go follow the Clemson Tigers around for a whole football season. Whatever discretionary things that aren't really necessary, but you want to do, that would go in the discretionary bucket. And you would set up spending strategies off of that, right? And you can dial your spending up and down in the discretionary bucket, right? Because it's discretionary. You don't need them, but that is essential. So non-railroaders, when they look at this approach, okay, it's very difficult for them. And this is the value proposition for railroaders, right? Is that Tier 2. You're filling up that essential expenses area with that Tier 2. And I talk about this all the time to railroaders because to me, it's so important, right? So if you're a non-railroader, and let's say you had that $1 million 401k I wanted to talk about, and you say you're a non-railroad, well, I got to get some guaranteed some retirement income. They could take almost half their retirement income, their retirement nest egg to pay for that retirement income, right? Why, as railroaders, you have that through your Tier 2 because you've been funding it throughout all your years in the railroad. So I like to use this slide here to kind of show you. So if you look at the Tier 2 part of it, I won't touch on it too much, but it's such a great point that you guys really have to understand this. So if you're, let's just say a couple, right, married railroaders, retires 60 and 30 after 30 years of service. And if you look here, oops, excuse me. So if you look here, pardon me, stay with me here. To get that retirement income stream, right, you know, I think it's close to $2,200 a month in retirement income there, and then another 45% for the spousal benefit. You would have to hand an insurance company about $525,000 to replicate that. So that is a huge amount of money, right? And that's your, right, that's your tier 2 here. So now you have your tier 1, tier 2, and now your discretionary. So once again, it's really important to understand that tier 2 valuation and how that's going to help you with your retirement income streams. So, so that's the dynamic asset allocation that I like to talk about. Cover the essential expenses with your guaranteed retirement income streams, and then your discretionary expenses are with your portfolio withdrawals, right? So let's talk about spending those spending strategies for you know, the portfolio withdrawals, managing that sequence of risk, right, with the spending. So there's 2 ways to do it. I'm a floor and ceiling guardrails type of guy, but let's just talk about spending ratchets. That's one way to do it, right? Because what we're trying to manage here is not only the downside of the risks that we talk about, right, that we're currently seeing in the markets, right, the move, well, we're down 34%, now we're down 20%, those type of moves that we have to worry about that, right? But we also want to worry about the upside moves, right? Maybe we're not spending enough now. Our portfolios are earning and now we're not spending enough of the money and we want to spend that perhaps. Maybe we do, maybe we don't, but if we want to adjust our spending also. So it's those guardrails or ratchets that people use to manage that. Not only the downside where they got to watch your discretionary spend, but the upside also. So spending ratchets are basically, one way to do it is, you know, every 3 years you review your portfolio. If the portfolio is ahead 50%, then you take a 10% raise in your spending. So let's say if you had $1 million and you were doing a 5%, you take out $50,000 every year. But let's say the portfolio went to $1.5 million. You give yourself a 10% raise. Now you're spending $55,000 a year, right? That's a ratchet. Ratchets up, ratchets up, ratchets up, depending upon the portfolio. All right. Now the way I like to look at it is I use the guardrail approach, right? So this is, you know, very dynamic, and we set an initial withdrawal rate, okay? And then it's kind of like a bowling alley where you have bumpers in there. So we want the portfolio rolling down the middle of the alley at 5%, but if it goes to either bumper, we're going to adjust. We're going to adjust our spending, right? So if the market goes down, that means our withdrawal rate that we set is actually going to be going up. So we need to reduce our spending by 10% and move the portfolio back to that 5% withdrawal rate. So let me just show you once again by an example on how this is how we'll do it at Highball Advisors here. So if you just take a look at, let's say you had an income baseline of $1 million, once again that 5% that we're talking about, and you had that would be $50,000 a year or $41.67 a month, right? You get $41.67 a month. Right? But now, oh God, you know, things are going on in the market. So if the portfolio, let's say in bad times, if it went down to $840,000, well, you would get a pay cut, so to speak. Your income would go down by 10%. It would go down to $37.50, right? But that would be your new baseline going forward, right? But you'd be at $37.50. However, if the market, right, let's say if you had that $1 million and the market went up to, let's say, 1.25 million, that's the pay raise. So you would go up to 55,000 and be 45.83. All right, so that's that dynamic guardrail approach, right? That I'm talking about. And some of the things, you know, things you have to do to make this work is, right, that rebalancing has to be done annually, right? You want to make sure that your portfolio is balanced every year. You know, the diversification, I'm big on that. You can't, you know, can't have all your eggs in one basket, so to speak. Tax efficiency, and then discipline, which is huge with any plan, right? We're making a plan together. You have to have the discipline to stick to the plan through good times and bads, because the plan, you know, it's been put together, it's been tested, and that's the way it's going to work. Or, you know, you can't say, oh, well, here's our spending plan. Oh, by the way, did I tell you, I wanted to, you know, buy a $250,000 RV or something, and that kind of blows out your spending plan, if you know, that type of thing. So it's a strategy. Nothing's guaranteed in life, right? Because at the end of the day, there's basically four things the market can always do, right? The market can always go up, or the market can go down and up, or the market can go up and then down, or the market can go down. Well, the first three we can cover with dynamic spending strategies, but if the market just ever goes down and just keeps going down, well, there's no strategy that can really help. And frankly, we haven't seen that ever, where the market, you know, Great Depression, the market still came back. So unless something goes straight down, I don't foresee that. So here's the rules for the guardrails, right? So let's say you had a prior year was negative return. You have to you apply the withdrawal rule. I don't want to get too technical, but basically it determines how to fund the spending for the next year. So like if you had a negative year, you use the existing cash and the fixed income when possible to fund next year's income stream, right? You want to keep those equities in there. So that's that rebalancing I talked about. You want to make sure you rebalance from the cash and the existing cash and the fixed income before you get to the equities. Then let's say if you had let's just say you stayed with, in the middle of the bowling alley, never touched the bumpers, well, you're just going to get an increase every year, whatever the inflation rate is, right? So if it's 2% this year, you get a 2% raise, and you just keep moving along, right? But let's say if if you had that down move, right, where your withdrawal rate went down because your portfolio went down, right? You have to cut your spending, right? You have to move it back. So I shouldn't say that. I mean, your withdrawal rate went up because the portfolio went down. So if the withdrawal rate has risen by 20% above the initial withdrawal rate, the withdrawals are going to be reduced by 10%, right? So that becomes your new basis, right? So that's the capital preservation rule, and vice versa, it's the same rule, right? I talked about it, right? If you had if your withdrawal rate came down to 4% because your portfolio went up so much, we want to increase your spending and get that withdrawal rate back up into the middle of the bowling alley. So we increase the spending by 10%, and that new rate becomes basis. So that's that dynamic strategy. You got to keep an eye on it and monitor that. So here they did a study on this, and look at the bottom of the screen, and that's that diversified portfolios here. So the one in the look here in the middle is 65% equities, 25% bonds, and 10% cash, right? And if you had an initial withdrawal rate of 5.4%, the success rate is 99%. Using that strategy, sticking to those rules that I just outlined, okay? And how would that have fared over the years, right? You would have had 1 cut and 5 freezes and 5 raises, okay? That's the way it would have worked out. And as you can see, if you had a more conservative approach in retirement, okay, your withdrawal rate is going to be lower, right? Because fixed income is never going to earn or increase in value as much. But you would also have, less cuts, less freezes, less raises, as opposed to a higher equity here, the 80-10-10, right? The 5.4%, you would have 2 cuts and 5 freezes and 7 raises, okay? So as you can see, it's, depending upon how the market sequence is there. But that's 30 years data looking at using that withdrawal strategy. So once again, I just wanted to, to recap. You want to use all of these together. There's some form, you don't have to use them all together, but you want to, set that withdrawal rate. You want to have a dynamic, that dynamic asset allocation, and then the spending strategy. So from my perspective, right, at Highball Advisors, we'll set that safe withdrawal rate, that annuitization floor where we're talking about essential spending, right? That's our baseline. And then discretionary is where our portfolio withdrawals are going to live in, right? We want to get that 80%, cover 80% of our expenses at a minimum with that guaranteed retirement income. And then we can live with our portfolio withdrawals. Okay, and then the dynamic spending, right? We talked about ratchets. Some people want to do that, that's fine. I like the guardrails, dynamic, and as you can see with that previous data, high degree of success with that, and spending, when the markets are good, you want to be able to spend that money, and when they're bad, you want to be able to adjust also. So that, gives you that level of comfort. And then this to me is the final important piece. So one of the things that I do, and all advisors really do, is they have investment policy statements, or at least they should. So you're talking to a, I'll talk to a client, and I'll say, tell me a little bit about your risk, some of your goals, that type of thing, and I'll come up with the recommendations for some investments, a diversified portfolio, that type of thing. And I put that into what they call an investment policy statement. So the client knows, okay, well, here's the risk I'm comfortable with. These are my goals, and these are the investments that we're going to go into. And the client signs off on it, and I sign off it, and that's the investment policy statement. But one of the important things also is the withdrawal policy statement, right? So how are you going to take that money out, right? So it's interesting because I've been feeling a lot of calls with this latest down move. You get a lot of people, that I'm just talking to day to day, and they'll call me up and say, oh, what do you think about the market? What do you think about the market? And these are just people that are coming, reaching out to me. And I said, well, what's your plan? Do you have that strategy in place? And they go, no. Well, this is what I'm talking about. This is so when the markets go down, right? You have that policy statement, that withdrawal policy. You already know. So if you know the market's going down, you're going to get a pay cut, right? Because we've planned for that. Or the market's going to go up, you're going to get an income rise because you planned for that. You've known that 80% of your essential expenses are covered through your guaranteed retirement income. You know what your initial withdrawal rate is, right? That's all part of the withdrawal policy statement, right? Income goals, available assets, where am I getting? How are we taking the money out, right? We're taking out from the taxable accounts, we're taking out from tax deferred, and then finally tax free, right? What's the triggers, right? Oh, when the market's up 20%, when it's down 20%. Those are the triggers. So you have to, if you have that plan in place, right, you can enjoy life. You don't have to watch, watch every CNBC or Fox Business News, every tick of the market, because you have these plans in place. And that's what I'm just trying to let everybody know, right? Get that withdrawal policy statement. What's your plan? Not only your plan for investing with your investment policy statement, but your plan for taking it out, also your withdrawal policy statement. Very, very important. So if you have advisors, work with them on that. Make sure you get that with them, because I think I know it's very valuable. It's very, very valuable. So that's it. That's all I have for you. Now, if you have any questions, let me know. I appreciate that. You can find me on LinkedIn. I'm at linkedin.com, /railroad retirement. Same for YouTube, /railroad retirement, Facebook, /railroad retirement. Reach out to me if you have if you need any help with anything, and I'll take a couple questions here. I see that there's just a couple questions here. Let's see here. Okay. Oh, one question here is on the, how does this say? I want to phrase this properly here. Oh, should I take out, if I have my tier 1 and tier 2 covering my essential retirement, should I fully fund my 401ks and IRAs? Yes. Okay, that's a good question. Thank you. Yes, you should always be funding those because the tax advantages, there's not many tax breaks available. And anytime you can put money away tax deferred and let it grow without is a good move. So you want to do that, even though, oh, you say, oh, I got my retirement income covered with that. Continue to put money away into those tax deferred, right? Better you to have that money than to Uncle Sam to have the money also. Another question here is, well, what happens if I live past the 30 years? Well, that's a great question. And life is funny. You can go 30 years, 40 years, and unfortunately, some people don't go even 30 years in retirement. The plan's in place. Actually, that plan that I talked about, the dynamic spending, there's also scenarios that goes out to 40 years, that type of thing. But as long as you're sticking to it, you're going to just keep growing the money. I mean, you can go 40 years, and you can see from the market, shouldn't say always, but you're going to come out ahead. You'll be fine on the 40 years, 30 years, 40 years. At that point, it really doesn't matter. It's those, really, the early sequence of returns is what really affects you the most, that's for sure. So, well, listen, everybody, I'm bumping up against, I wanted to keep this at 45 minutes. If you have any more questions, you can email me at John@Highball Advisors. Reach out to me if you want to talk more about this. Talk about it. If you're working with advisors, talk to them about some of these strategies, put them in place. Like I say, connect with me, and I hope everybody got something out of it. I'm going to be doing another webinar in May. Hopefully, we'll keep our fingers crossed. I'm working with the Railroad Retirement Board to have one of their professionals come in and answer your questions and give us a little talk. I think that will be good for everybody. So I'll announce that more later. But anyway, everybody, please, I guess more important than ever, please stay safe and stay on track and take care. Till next time, everybody. Take care. So long. Bye.